You thought you were trading price, candles, indicators, green and red lines blinking on a screen like a video game. But what if I told you none of that is real? What if I told you that every losing trade you've ever made wasn't your fault because you never actually saw the game? Imagine for a moment that underneath every chart you've ever looked at is a hidden skeleton, a structure, a language the market speaks fluently, while retail traders try to interpret the noise. And unless you learn to read it, you're not trading. You're gambling with a blindfold on. Welcome to Trading Psychology Stick, where we decode the hidden patterns that move markets. Quick disclaimer, what you're about to learn isn't financial advice. It's educational content designed to transform how you see price action. Your results depend on your application, discipline, and risk management. Here's the paradox that keeps most traders broke. The more indicators you add, the more you distract yourself from what's actually moving the market. Because price doesn't move randomly, does it? It moves with intention. And that intention is always expressed through structure. Structure is not a tool. It's not a tactic. It's the foundational language of the market. The thing institutions use to build positions while retail traders chase ghosts. Let me ask you something. Have you ever seen price break a key level only to reverse violently and leave you stuck on the wrong side? That wasn't bad luck. That was structure doing its job, grabbing liquidity, completing a pattern, shifting character. While you were reacting to a breakout, the market had already made its decision 5 swings ago. That's how professionals think. They don't chase, they don't predict, they read. And now, so will you. Because this series isn't about setups, it's about sight. And by the end of it, you'll see markets differently. You'll see the swings, the breaks, the pivots. Most importantly, you'll see the story they're telling. Forex or crypto, doesn't matter. Structure is universal. It's the language of price. And it's time you learn to speak it fluently. Section 1. Structure is truth, the skeleton beneath every market. The market doesn't move because of headlines, emotions, or your favorite indicator. It moves because of structure. And structure is not a trend line or a fancy tool. It's the bones of the market, the framework, the underlying architecture that reveals how price breathes, expands, contracts, and finally commits. Most traders never see it. They're distracted by the drama, the breakout, the spike, the green candle that makes their heart race. But professionals, they see the skeleton, and that's why they win. Imagine you're watching a trader open his chart. Bitcoin is pumping hard. He panics. He buys. The next hour it crashes. Again, he blames the market, doesn't he? But zoom out, and a different picture emerges. What looked like a breakout was actually a liquidity sweep above a key high. The final grab before the real move down. The structure was clear. Higher low, failed continuation, shift in character. It wasn't noise. It was a message. But the message only reveals itself to those who know where to look. Structure begins with 3 simple ideas: swing highs, swing lows, and the sequences they form. When price makes a higher high followed by a higher low, it's trending up. When it makes a lower high followed by a lower low, it's breaking down. That's it. This is not theory. It's not strategy. It's how every market breathes. And yet, most ignore it. They rely on indicators to interpret what structure already told them 3 candles ago. But here's the secret. The market never changes direction randomly. It transitions. And that transition is visible through break of structure, through change of character, through liquidity behavior. The skeleton speaks first, always. And if you listen closely, you'll notice something magical. Price doesn't lie. It's just that most traders don't understand what it's saying. Take a moment to reflect. How many times have you entered a trade based on how you felt, rather than what the structure showed? If you're honest, probably more than you'd like to admit. Comment below with one word that describes your biggest trading struggle. Is it patience, discipline, fear? Let's build awareness together. Institutional traders, the ones who actually move price, don't guess. They track structure. They let retail chase the top, buy the breakout, sell the dip. Meanwhile, they wait for the sweep, the BOSS, the CHoCH, the shift. They enter where retail exits, and they hold where others panic, because structure tells them when the story has changed. So, the question becomes clear: can you learn to read it? Can you train your eye to see beyond the candle and into the anatomy of the market itself? Because once you do, trading stops feeling like guessing. It becomes recognition, pattern, precision. Not because you're predicting, but because you're following what's already been written. The skeleton is there. It's always been there. Now let's learn to see how it moves, how it breathes, and most importantly, how it tells you exactly where price wants to go next. Section 2. The language of trend. How structure tells you where price wants to go. Every trader wants to know where the market is going, but few realize the market has been whispering the answer all along through trend. Trend isn't a line on a chart. It's a sentence in the market story, and that sentence is written in the sequence of higher highs and higher lows, or lower highs and lower lows. Once you understand this, you stop trading in isolation. You start reading in context. Imagine you're watching ETH in early 2024. It had rallied for days, every dip getting bought, every breakout pushing higher. But one day, it pulled back deeper than usual. It bounced, yes, but it failed to break the last high. Then it dropped. Hard. Traders who bought the dip again got caught. But this time, it didn't bounce. It broke the last low, and many got liquidated. Why? Because they were trading yesterday's trend. They weren't reading today's structure. The market had shifted from bullish sequence to bearish transition, and they ignored the grammar of trend. Trends are structure in motion. An uptrend is a dialogue. Buyers are in control, and it keeps repeating until something interrupts that rhythm. A failed high, a break of a key low, a shift in character. That's when the market whispers, the story is changing. But most traders aren't listening, are they? They're hoping, guessing, copying. Now, let me share something that changed my perspective forever. Trends aren't just direction, they're psychology. An uptrend means buyers are confident. A downtrend means sellers have conviction. A sideways range means indecision. But within each of these, structure leaves footprints. Compression before breakout, sweep before reversal, clean swing continuation. It's all there. If you know how to look, when you learn to read trends structurally, you gain something priceless, timing. You know when to follow. You know when to stand aside. And most importantly, you know when to prepare for the reversal before it happens. Not after the damage, not after the loss, but right at the moment when structure hesitates. And that's why indicators lag. They wait for confirmation. But structure is the confirmation. It tells you when flow shifts, when imbalance returns, when the market is no longer in agreement. That's when the smart money leans in. That's when setups actually matter. Think about the power of this. While others are still wondering if the trend has changed, you already know. You saw the failed high. You noticed the deeper pullback. You recognize the character shift. You're not guessing anymore. You're reading what's already written in the language of swings. So, next time you look at a chart, don't just ask, where's price going? Ask yourself, what phase of structure am I in? Because once you see trend as structure, not direction, you stop fighting the market. You start flowing with it. But what happens when that flow breaks? When the sequence shifts? When structure stops telling the same story and starts writing a new one? That's where the real opportunities hide. And in the next section, we'll master the art of spotting these transitions before everyone else even knows the story has changed. Section 3, when structure breaks, mastering CHoCH and the lies the market tells. The market rarely screams when it's about to reverse. It whispers. And if you're not tuned in, you'll miss it. What separates pros from amateurs isn't who has the better entry. It's who recognizes when the entire character of the market just changed. That shift has two names, break of structure and change of character. But here's what they don't tell you. Sometimes structure lies. Let's set the stage. Imagine you're watching EUR/USD on the 4-hour chart. It's been bullish for weeks. Classic higher highs, higher lows. Every dip is a gift. Then one day, price fails to make a new high. It pulls back deeper than usual. You still believe. So, you buy the next low. But instead of bouncing, price breaks the most recent swing low. Clean. That's a break of structure. And that's your first whisper. The flow is weakening. But here's the twist that catches everyone off guard. A BOS can happen inside a continuation. It doesn't always mean reversal. That's where change of character comes in. CHoCH is the first time the market switches polarity. When a downtrend suddenly creates a higher high, or an uptrend breaks and makes a lower low, it's the moment the story breaks pattern. And if you're listening, you realize something powerful. Structure has stopped continuing. It's starting to resist itself. Now, let me blow your mind with something most educators won't tell you. Structure failures. These are the times when the market sets up a perfect BOS or CHoCH, only to fake everyone out. Picture this scenario. Bitcoin shows a bullish structure, HH, HL, momentum up. It breaks above a recent high. Traders enter. But instead of continuing, price pauses, wicks, then collapses, breaking the last low in a single brutal candle. They're confused, but it broke structure. Wasn't that a continuation? No, that was a liquidity trap disguised as a BOS. A false continuation before a major reversal. Most retail traders miss this completely. They see a BOS and think, it's just a pullback. They see CHoCH and assume it's noise. They see a structure failure and blame bad luck. But structure doesn't break without reason. Behind every shift is an imbalance in liquidity, sentiment, or narrative. And those who read these nuances don't just get in early. They position themselves where others get trapped. Here's what you need to understand. CHoCH is not a signal. It's a statement. This is no longer what it was. And the best entries happen right after CHoCH, during the retest, when the new structure proves itself. That's where conviction lives. That's where asymmetric risk appears. But how do you spot when structure is lying? 3 things to watch for. First, lack of follow-through. Price breaks structure, but stalls immediately. No volume, no conviction. Second, aggressive rejection, fast wick rejections, or engulfing candles immediately after a break. Third, liquidity context. The break happens into a known liquidity pool like equal highs, not beyond it. Pause for a moment and ask yourself, how many times have you held on to a losing position because you couldn't accept that character had changed? Or worse, how many times did you exit a winning position because you fell for a fake structure break? If you're finding value in understanding these shifts, type structure in the comments. It helps me know what resonates with you. Smart traders use structure breaks as a filter, not a trigger. If a BOS fails, they don't double down. They observe. Is price rejecting cleanly? Is the reaction emotional? Are others trapped? If so, they know the real move is coming in the other direction. They fade the fake and ride the real. And that's the paradox of structure. You must trust it enough to build your edge and doubt it enough to protect yourself from traps. It's a dance. And the best traders aren't rigid. They adapt. They let the market lead, and they follow with precision. Think of it like a chess game. You study the patterns. But when your opponent blunders, when they make a move that breaks every known tactic, that's your opening. Structure failures are blunders. They're windows into the market's emotional core. And if you stay present, they guide you straight into high-probability reversals. So the next time you see structure break, don't react. Respond. Ask yourself, is this a genuine shift in market character, or is this the market hunting for something? Because once you understand both the truth and the lies, structure tells, you're no longer trading patterns. You're trading intention. But structure doesn't move on its own. It's driven by something deeper, a hidden force that moves price not based on value, but based on need. And in the next section, we'll uncover the dark heart of the market, the liquidity that fuels every trap, every spike, every fake out you've ever experienced. Section 4, Liquidity, the market's hunger for your stop loss. You were never the target. Your stop loss was. Most traders think the market is trying to go somewhere. It's not. It's trying to find someone. The person who's most vulnerable, most convinced they're right, most willing to give up control. That person is usually you. And the thing they want? Liquidity. Your exit order. Your emotional breaking point. Because in truth, the market doesn't move to reward smart traders. It moves to fill the needs of those who control the game. And they need liquidity to enter. Imagine you've identified a clean resistance zone. Price has tapped it twice. Everyone sees it. You go short on the third touch, confident. But what happens? Price breaks above it. Your stop gets hit. You rage. Then it collapses hard. You were right and still lost. That wasn't manipulation. That was liquidity harvesting. Now picture this from an institutional perspective. They have millions to deploy. They can't just market buy without moving price against themselves. So what do? They engineer liquidity. They push price into obvious stop-loss zones, collect the orders, then reverse. It's not personal. It's structural. Liquidity zones are areas where orders are clustered, equal highs, clean lows, obvious breakouts. In those zones sit thousands of traders just like you, waiting, hoping, reacting. And institutions know it. They don't chase price. They create the illusion of movement to trigger your reaction. Once they have your liquidity, they move in the opposite direction. It's not evil, it's structural. Like a lion stalking a herd, it waits for the weak to step out. Then it strikes. But here's what makes this even more powerful. Liquidity creates the very structure breaks we just discussed. That false bias, it was grabbing liquidity above the high. That failed CHoCH, it was sweeping stops below the low. Structure and liquidity are married. You can't understand one without the other. Smart money doesn't buy dips. They buy after the sweep. They don't sell breakdowns. They sell into the breakout. Because they know, before any real move happens, the market must clear the weak hands. This is why so many breakouts fail. Because breakouts aren't designed to free you. They're designed to trap you. Structure without understanding liquidity is a half-built map. You see the trail, but not the cliffs. And this is where things get deeper. Because liquidity isn't just horizontal. It's emotional. Every time you set a stop loss, you expose a part of your psychology. The market doesn't just take your money, it takes your confidence. It feeds off your certainty. That's why the best traders aren't just technical. They're patient. They wait for the sweep, the shift, the reclaim. Only then do they act. Case in point, the 2017 Bitcoin run to 20K. Remember the exact top? Price wicked above 20K, grabbed all the euphoric longs, then crashed 70% over the next year. That wasn't random. That was a liquidity event at a psychological number. The market found its fuel and used it to reverse. Here's a mental shift that will transform your trading. Start seeing stop losses not as your protection, but as the market's target. Once you understand this, you'll start placing them differently, beyond the obvious, behind the liquidity, where the real protection lives. So next time you see a clean level, ask yourself, who's on the other side? Is this a real break or a baited hook? Because once you understand liquidity, you stop trading levels and start trading behavior. You stop being the hunted and start thinking like the hunter. And yet, even when you understand structure and liquidity, you're still half blind. Because these patterns play out differently across time. What looks like opportunity on one time frame might be a trap on another. And in the next section, we'll unlock the multi-dimensional view that separates amateur traders from professionals. Section 5. Multi-time frame mastery. Seeing the complete story. The market is a fractal, a story told at different speeds. What looks like chaos on the 1-minute chart might be a perfect pullback on the 1 hour. What feels like a breakout on the daily might just be a fake out on the weekly. And yet, most traders treat every chart like it's the only truth. They zoom in, take the trade, and wonder why the market felt like a trap. But the trap wasn't in the price, it was in your perspective. Multi-time frame structure is how pros see the market in layers. They don't just ask, where's the next candle going? They ask, what phase is this chart in within the larger structure? It's like reading a sentence in a novel. You can't understand the meaning unless you know the chapter. Imagine a trader looking at GBP/JPY on the 15-minute. He sees a bullish CHoCH. He buys. It looks clean. Structure shift, momentum up. But what he doesn't see is that the 4-hour is in a confirmed downtrend and that 15-minute shift. It's just a retracement into a bearish order block. He gets stopped out. Not because his analysis was wrong, but because it was incomplete. He was trading a sentence without knowing the plot. Here's something that transformed my trading forever. Professionals define a dominant time frame, usually H4 or daily, to determine bias. Then they drop to lower time frames, M15, M5, to fine-tune entries. The lower time frames give the trigger. The higher time frames give context. You don't trade the M5 just because it shifted bullish. You trade it when the M5 aligns with a bullish structure on H1 or H4, and when liquidity has already been swept. This alignment creates what smart money calls confluence. A higher time frame, BOS, plus lower time frame, CHoCH, plus liquidity sweep equals asymmetric opportunity. It's not about sniper entries. It's about reading the bigger frame and entering when structure agrees on all levels. The trade doesn't just look right, it feels inevitable. Think about it like weather forecasting. If the weekly chart is a storm system, the 1 minute is a gust of wind. Would you open an umbrella because a breeze blew past? Or would you check the radar first? Every time frame gives you a slice of truth, but only when stacked together do they reveal the real story. If you've ever been stopped out on what looked like a perfect setup, only to watch price move in your direction afterwards, drop a time in the comments. You're not alone. We've all been there. The key is learning from it. And this matters more than ever in fast markets like crypto. BTC might look bullish on the hourly, but zoom out and you'll see it's simply retesting a broken weekly support. That's how people get trapped. They zoom in, feel confident, and forget the larger war being waged above their screen. But here's the real secret. Timeframes don't just show you different views, they show you different players. The 1-minute chart, that's noise traders and algorithms. The 4-hour, that's position traders. The daily and weekly, that's where institutions build campaigns. When you understand who's playing on each time frame, you understand why moves happen when they do. So, before you enter any trade, ask yourself 3 questions. What does the higher time frame say? Is this entry flowing with the dominant structure or fighting it? Is this setup appearing at a key inflection point or in the middle of nowhere? Because structure exists on every time frame, but edge exists when they all align. When the weekly shows accumulation, the daily shows a bullish shift, and the hourly gives you a clean entry after a sweep. That's not luck, that's multi-dimensional thinking. And once you master seeing the market in layers, something else becomes clear. Structure doesn't just exist in space, it exists in time. And in the next section, we'll decode why when you trade matters just as much as what you trade. Section 6, Timing in Sessions, why when matters as much as where. You could have the perfect setup. A clean CHoCH, a textbook BIOS, liquidity swept, time frames aligned, and still lose. Why? Because the market doesn't just move based on structure, it moves based on when that structure appears. Timing isn't optional, it's everything. You see, the market is like a theater performance. The same scene, the same dialogue, hits differently depending on when it happens. A bullish CHoCH at 2 a.m. might be noise, but the same move at London Open, that's a statement. The players are different, the stakes are different, and most importantly, the liquidity is alive. Every trading day breathes in sessions. Asia, London, New York. And each session has a rhythm. Asia creates the range, London breaks it. New York either extends or reverses. And smart money knows this. That's why they don't just look for setups. They wait for the right moment to strike. Here's a pattern I've observed countless times. A trader sees a sell setup on EUR/USD during New York lunch. Low volume, quiet market. The CHoCH is clean. The entry looks perfect. But price grinds sideways, stops him out, then dumps 2 hours later when volatility returns. The setup wasn't wrong. The timing was. He was early. And in trading, early is the same as wrong. Smart traders align structure with time. They wait for high-impact windows, 15 to 30 minutes after session opens, right before or after major news, end-of-week closes for trap exits. Because that's when the market is obligated to show its hand. That's when volume is real, stop hunts are active, and institutional flow is present. Structure means nothing if nobody's there to move price. Imagine watching a perfectly formed CHoCH at 3 a.m. EST. Clean break, good momentum. But who's trading? The skeleton crew, the market makers on autopilot. Now imagine the same setup at 8:30 a.m., 30 minutes after New York opens. Same pattern, completely different outcome. Why? Because timing determines participation, and participation determines power. One powerful concept in trading is the Judas swing. These are fake moves during the first hour of a session designed to trap early traders, only to reverse once enough liquidity is gathered. These traps happen on schedule, almost like clockwork, and once you see them, you never unsee them. But timing goes even deeper than sessions. It's about understanding the rhythm of the trading week, Monday's range creation, Tuesday and Wednesday's expansion, Thursday's momentum, Friday's positioning. Each day has its own character, its own tendencies. And when you align your trading with these rhythms, you stop forcing trades. You start flowing with the market's natural breath. Here's something fascinating. The best traders often take their biggest positions not when structure is cleanest, but when structure aligns with optimal timing. They understand that a B+ setup at A+ timing beats an A+ setup at C timing every single time. So, how do you build this into your trading? You don't just mark BIOS or CHoCH. You timestamp them. You note the session. You track which times of day your edge performs best. Because patterns without timing context are just pretty pictures. And this brings us to a crucial realization. The market isn't just a technical machine. It's a living organism with moods, rhythms, and personalities that shift throughout the day. And in the next section, we'll explore how these moods, these waves of emotion, create the shifts that make millionaires and break beginners. Section 7. Sentiment and market shifts, when psychology creates opportunity. The market isn't made of lines. It's made of people. Behind every swing high is hope. Behind every stop loss is fear. Behind every breakout is a crowd of traders rushing in, thinking this time will be different. Structure shows you the pattern, but sentiment shows you the motive. And when you combine the two, you see something powerful. The exact moment when psychology shifts and opportunity is born. You've felt it before, haven't you? Bitcoin breaks all-time highs. Social media explodes. Everyone calls for 100K. You buy in, not because of structure, but because of emotion. Because the crowd made you believe this was the move. But what you missed was the sweep, the trap, the subtle rejection from the supply zone nobody wanted to acknowledge. 2 weeks later, price is down 30%. Sentiment drove you in. Structure never backed it up. The crowd is always loudest at the worst time. When price is euphoric, when volume is peaking, when headlines scream moon missions, that's when smart money exits. Why? Because mass sentiment is liquidity, and retail sentiment is predictable. It always chases, always panics, always overcommits. But here's what most don't understand. Sentiment doesn't just influence price, it creates the very structure shifts we've been studying. When fear reaches extreme levels, when everyone is convinced the world is ending, that's often when the market finds its floor. Not because of some magical support level, but because there's no one left to sell. The sentiment has exhausted itself. This is what we call a market structure shift. It's not just a CHoCH or a BIOS. It's the combination of structure change with sentiment extreme. It's the moment the market completes a hidden agenda, sweeps the final liquidity, and then commits with conviction. Not just breaking a level, but declaring, the story has changed. Let me paint you a picture. Imagine watching Solana in early 2023. It had been dead for months, range-bound, forgotten. The sentiment was pure despair. It's going to zero. Another dead project. Then one day, it fakes a breakdown, takes out the lows. Everyone who still believed finally capitulates. But what happens next? Price reclaims the range, then breaks a clean lower high. Volume kicks in. Sentiment flips. That wasn't just a breakout. That was a market structure shift. Smart money had finished accumulating while sentiment was at its darkest. The trend was no longer down. It wasn't just a reversal. It was a declaration of power. A true market structure shift has 3 ingredients. First, a liquidity event. Price sweeps obvious lows or highs where emotional traders are trapped. Second, a break of the previous internal structure, often overlooked by retail still focused on the old narrative. Third, a clean, high-volume BOS in the opposite direction with conviction, not hesitation. Here's something profound. The best trades happen when structure and sentiment disagree. When the charts show bullish structure, but everyone is bearish. When price makes a higher low, but the crowd is screaming lower. That disagreement, that's your edge. Because one of them is wrong, and it's usually the crowd. Smart money uses structure to map the battlefield, and sentiment to predict where the next casualty will be. They look for long wicks at highs with euphoric news, sudden reversals right after bullish confirmations, panic selling into demand zones with no structural break. They fade the crowd, not emotionally, but structurally. And it's not just news or social media. Even price itself is tells. Fast, aggressive moves often indicate emotional imbalance, gaps, spikes, liquidity hunts. Those aren't organic. They're reactions. And every overreaction is a setup for reversal. Here's a quick exercise that will sharpen your sentiment radar. Next time you're about to enter a trade, pause and ask, what is the crowd feeling right now? What are they expecting? If your trade aligns with mass expectation, reconsider. If it fades the obvious, you might be onto something. Share your biggest crowd trap story in the comments. We learn from each other's experiences. So, how do you trade this? Simple. Map structure first. Then overlay the sentiment. Are you seeing a CHoCH into a news-driven panic? That's a gift. Is the crowd piling into a breakout before the BOS? That's a trap. You don't trade sentiment blindly. You use it to validate or invalidate what structure is suggesting. Because price doesn't move in a vacuum, it moves through people, through their fear, their greed, their doubt. And once you understand that, you stop being part of the crowd. You start trading them. But even with perfect structure, timing, and sentiment analysis, you're still vulnerable, because one thing can destroy even the best trader: poor risk management. And in the next section, we'll build your survival system for thriving in any market condition. Every candle on the chart is a story of someone risking too much and someone risking just enough. One gets wiped out. The other lives to fight another day. The difference isn't intelligence, it's survival instinct. Because in trading, you don't win by being right. You win by staying alive long enough for your edge to pay off. Structure shows you where opportunity lives. Risk management tells you how much of yourself to put into it. But here's the twist. Risk isn't static. It evolves, just like the market. And if you can't adapt your risk to changing conditions, even perfect structure becomes a death trap. Let's walk through a painful but common scenario. You spot the setup: liquidity swept, CHoCH confirmed, time frame alignment. You enter, and it works for a moment. But news drops, a flash move, spread spikes, price wicks down, tags your stop, and then rips in your direction. You're out, angry, frustrated. Then you realize you risked 10% of your account. You thought this was the one. Now you're emotionally compromised, sizing up the next trade to make it back. But the next trade doesn't work. Neither does the one after. You're not losing to structure. You're losing to position size. And worse, you're not adapting to the market's changing personality. The best traders risk little, but compound a lot. 1 to 2% per trade, clean stop, predefined invalidation. But here's what separates survivors from casualties. They adjust their risk based on market conditions. Choppy market, smaller size, clean trending conditions, normal risk, major news week, reduced exposure. They're not rigid. They're responsive. Because structure gives you the stop. If you enter on a CHoCH after a liquidity sweep, your stop goes below the sweep. Simple. If structure breaks against you, you're out. No negotiation, no, let me give it space. But the size of that position, that depends on the market's current behavior. Think about it like driving. You don't drive the same speed in a storm as you do on a clear day. The road is the same. Your destination is the same. But the conditions demand adaptation. Trading is no different. And this adaptability extends beyond just position sizing. It's about recognizing when the market itself has changed. Remember the 2020 to 2021 crypto bull run? Structure was clean. Trends were powerful. Every dip was bought. Then came 2022. Same pattern started failing. CHoCH entries that printed instantly before now chopped sideways. Liquidity sweeps went deeper. The market's personality had shifted. Rigid traders kept trading the old playbook, bleeding slowly. Adaptive traders recognized the regime change. They widened stops, reduced frequency, waited for cleaner setups. Some even stepped aside completely, preserving capital for when conditions improved. That's not weakness, that's wisdom. Here's how you build an adaptive risk system. First, categorize market conditions: trending, ranging, volatile, quiet. Then assign risk parameters to each. Trending markets might get full 1% risk, choppy conditions might get 0.5%. News-heavy weeks might mean no trading at all. Second, track your performance in different conditions. You might discover you excel in volatile breakouts but struggle in quiet ranges. That's valuable data. Trade larger when conditions favor you. Trade smaller or not at all when they don't. Third, build evolution into your process. Every month, review not just your trades but the market's behavior. Has volatility increased? Have patterns changed? Are sweeps getting deeper? Let the market teach you how it wants to be traded right now, not how it was traded last year. Because here's the brutal truth. The market doesn't care about your system. It doesn't care about your back tests. It evolves, and you either evolve with it or become extinct. But when you combine solid risk management with intelligent adaptation, you become anti-fragile. You don't just survive market changes, you thrive on them. Great traders aren't afraid to lose. They're afraid to not adapt. One loss should teach you something. One changed condition should refine your approach. Because in this game, it's not the strongest who survive. It's the most adaptable. And that adaptability isn't just external. The biggest evolution happens inside you. In the next section, we'll master the inner game that turns good traders into great ones. Section 9, the inner game. mastering your psychology for consistent execution. You can read the structure perfectly, spot every CHoCH, every BOS, every liquidity sweep before it happens. Your timing can be impeccable, your risk management flawless. But when the moment comes, when your money is on the line and your heart rate jumps, all that knowledge vanishes if you can't control one thing: yourself. Because the truth is, most traders don't lose to the market. They lose to their emotions about the market. Fear, greed, doubt, overconfidence. These aren't side effects. They're the invisible traders sitting next to you, clicking your mouse before your logic has time to speak. Picture this internal battle. A trader sees a perfect setup. Structure is aligned, liquidity has been swept. Time frame confluence is clean. He's waited days for this exact pattern. But when price approaches his entry, he hesitates. His brain floods with, what if? What if it fails like last time? What if this candle wicks me out? What if it keeps running after I take profit? He hesitates. Price moves without him. He watches. Then, frustrated, he chases late. It reverses. He loses. Not because of his analysis, but because of the voice inside that hijacked the moment. But here's what separates professionals from amateurs. Emotional control isn't about suppressing feelings. It's about understanding them, noticing when fear is trying to protect you from imaginary pain, or when greed is whispering that this one's the big one. Because those voices will always be there. But structure gives you something they don't: neutral truth. Either price broke structure, or it didn't. Either we swept liquidity, or we didn't. Your job is to anchor to that truth and act from it. And this is where growth mindset becomes your superpower. Every loss isn't a failure, it's data. Every emotional hijack isn't weakness, it's information about where you need to strengthen. The best traders aren't built in bull runs. They're forged in the quiet hours after a stop loss, in the reflection after a strategy stops working. You stop saying, "I'm not good at this," and start saying, "I haven't mastered this yet." You stop thinking, "This setup failed," and start thinking, "This setup revealed something I missed." You stop chasing confidence from results and build it from process. I've noticed something powerful in my own trading. When I feel that emotional surge, that urge to chase or freeze, I literally say out loud, "What does structure say?" It's like a reset button. Try it. Next time you feel the heat rising, ask the question. Let structure be your North Star when emotions want to steer you into the rocks. Top traders have routines, pre-trade checklists, journals. They don't rely on how they feel. They rely on how the structure behaves. They know their weak spots. They have rules for when to walk away. Some only trade certain sessions. Some limit trades per day. Not because they're weak, but because they're disciplined. And discipline is what makes structure powerful. Here's how you build unshakable psychology. First, journal every trade, not just outcome, but emotion. Rate your clarity. Did you follow the plan? Did fear hijack you? What was your internal dialogue? This isn't about judgment, it's about awareness. Second, visualize scenarios in advance. See yourself executing perfectly when price approaches your entry. See yourself taking the stop calmly if structure fails. Mental rehearsal builds emotional muscle memory. Third, create state management rituals. Maybe it's 3 deep breaths before opening your charts. Maybe it's reviewing your rules out loud. Maybe it's a specific playlist that centers you. Whatever works, make it consistent. Because consistency in preparation leads to consistency in execution. Because in the end, structure isn't just a map of the market. It's a mirror of your mind. If you can't hold your psychology steady, even the best setup becomes sabotage. But when you master the inner game, something magical happens. You stop reacting to the market. You start responding to it. You stop being controlled by price. You start dancing with it. And this brings us to the final piece of the puzzle, because all of this knowledge, all of these insights mean nothing without implementation. In our final section, we'll transform theory into practice, turning you from student to practitioner. Section 10, From Knowledge to Mastery, Your Path Forward. Most traders treat the chart like a prediction machine. They stare at the present, try to guess the future, and hope they're right. But the traders who last, they don't look forward, they look back. Because hidden in the past are patterns that repeat with eerie precision if you know how to see them. And the bridge between knowledge and mastery isn't a secret system, it's deliberate practice. You've learned the language of structure. You understand BOS and CHoCH. You see liquidity. You respect time. You read sentiment. you manage risk. You've even begun mastering your psychology. But here's the truth. None of that matters until it becomes automatic, until recognition becomes reflex. This is where backtesting becomes your secret weapon. But not the way most do it, looking for wins and skipping failures. True structure-based backtesting is different. You study both the wins and the failures. You ask specific questions. Did this CHoCH form after a liquidity sweep or in the middle of a range? Was there follow-through after BOS or hesitation? What time did this structure shift happen? What session? What was the sentiment context? You're not testing a system. You're training your perception. Here's your homework, and yes, this is where the rubber meets the road. Tonight, open your charting software, pick any pair, go back 3 months, find 5 CHoCH patterns, screenshot them, note the time, the session, what happened next. Do this for 30 minutes. That's it. Small steps create big shifts. Comment, ready, if you're committed to doing this tonight. But backtesting is just the beginning. The real transformation happens through reflection. Every week, review not just your trades, but your evolution. What patterns are you seeing more clearly? Where is structure speaking loudest? What market conditions favor your developing edge? This is what reflection gives you: perspective, pattern recognition, emotional detachment, and most importantly, structure inside your own evolution. You journal not like a diary, but like a detective, building a case file on your own growth. And here's what nobody tells you. Mastery isn't a destination. It's a practice. The market will evolve. Conditions will change. What works today might fail tomorrow. But if you've built the foundation of reading structure, managing risk, controlling psychology, and constant adaptation, you don't just survive these changes, you profit from them. Because at the highest level, trading isn't about predicting. It's about responding. It's about being so aligned with market structure that you move with it, not against it. It's about being so clear on your process that emotion can't derail you. It's about being so adaptive that no market condition catches you off guard. The path forward is simple, but not easy. Every day you practice seeing structure. Every trade, you practice discipline. Every loss, you practice learning. Every win, you practice humility. Because the market is the ultimate teacher, but only if you're willing to be the eternal student. So, where do you go from here? You don't need another course. You don't need a magic indicator. You need repetition. You need to put in the hours watching structure unfold. You need to experience the patterns until they become part of you. You need to fail enough times that fear loses its grip. You need to win enough times that confidence becomes quiet certainty. The market doesn't need you to be perfect, just present, structured, and consistent. If you've made it through this journey, chapter by chapter, pattern by pattern, insight by insight, then pause for a moment. Let it land. You've learned that structure is not a tool, it's a language. You've discovered that CHoCH and BOS are not just acronyms. They're the heartbeat of price. You've explored how liquidity is in chaos, its intention disguised as noise. You now see that timing is everything, sentiment is energy, and adaptability is your oxygen. But most importantly, you've started to turn trading from a reaction into a ritual. So now the question isn't, what should I trade this week? The real question is, who am I becoming through this process? Because trading doesn't just reveal the market, it reveals you, your fears, your patterns, your control issues, your growth. And here's the challenge. Don't just watch this video. Don't just nod at the insights. Do something. Now. Pull up your last 5 trades. Look at the structure before each one. Was it aligned? Was the CHoCH clean? Was the BOS confirmed? Write 1 sentence per trade. Here's where I honored structure, and here's where I ignored it. This isn't about judgment. It's about awareness, because awareness is where change begins, and change is where edge lives. Then comment below, I'm now trading with structure. Here's what I'm changing. Be specific. Maybe it's, I'm adding timeframe confluence checks. Maybe it's, I'm waiting for liquidity sweeps before entering. Maybe it's, I'm journaling my emotions, not just my trades. Whatever it is, declare it. Let this be your public reset, your new standard. You're not here to be a signal follower. You're here to be a structure reader. You're not here to predict the market. You're here to listen to it. You're not here to feel in control. You're here to respond with clarity. So let this be your edge, not the system, but the site, not the setup, but the structure, not the prediction, but the patience. And remember, structure is the story, liquidity is the twist, your mindset is the author. Now, go back into the market and write a better chapter. Welcome to the journey. The real work starts now. What if I told you the most successful investor in history didn't trust the stock market? He didn't read financial statements, didn't care about economic forecasts, didn't follow CNBC. In fact, he thought most of Wall Street was full of noise, overconfident men in suits chasing randomness. While they argued about interest rates and company earnings, he quietly built a machine. A black box, a mathematical oracle that didn't just predict the market, it exploited its every twitch and whisper. His name is Jim Simons, a brilliant mathematician, a codebreaker during the Cold War, a professor who didn't even like business. And yet, he became the architect behind the most profitable hedge fund in human history, Renaissance Technologies. Its flagship, the Medallion Fund, returned an average of 66% per year for over 2 decades. That's not a typo, 66% year after year during dot-com crashes, financial meltdowns. Every storm, they thrived. And they did it with no crystal ball, no insider tips, just data, lots of it, fed into complex algorithms, guided by cold math, and executed by machines faster than thought. So, how did Jim Simons go from solving abstract geometry problems to solving the most chaotic puzzle of all, human behavior in the markets? That's the story you're about to hear. But be warned, this isn't just about money, it's about genius, obsession, betrayal, power, and a vision so precise it made emotion obsolete. You're not just going to learn how he did it, you're going to see why most people never could, because this isn't the story of a trader, it's the story of a man who rewrote the rules of reality, one equation at a time. Lesson 1, the reluctant genius. Jim Simons never intended to become rich, or famous, or feared. In fact, if you'd asked him early in life what he wanted, he'd probably have said something about solving unsolvable problems and drinking good coffee. He was, by every standard, a mathematician's mathematician, a man obsessed with the beauty of logic, the symmetry of theory. He had no love for Wall Street, no ambition to chase charts or earnings. But the universe, as it often does, had other plans. Born in 1938 in Massachusetts, Simons showed brilliance early. Numbers weren't just numbers to him. They were puzzles, languages, stories. By his 20s, he'd earned a PhD from Berkeley and was publishing groundbreaking work on differential geometry. His colleagues joked that Jim could solve complex equations while floating in his swimming pool, which, it turns out, he actually did. Picture this, a grown man drifting on a pool float, scribbling formulas on waterproof paper. That was his idea of vacation. Then he joined the Institute for Defense Analyses, an elite think tank tied to America's deepest intelligence operations. There, his job was to crack enemy codes, Soviet ciphers, hidden signals, mathematical ghosts. He wasn't reading enemy plans, he was reverse engineering the logic behind them, and he was very, very good. But here's where it gets interesting, and slightly absurd. Simons was fired for opposing the Vietnam War, not quietly fired, publicly. The New York Times actually ran the story. Top codebreaker, fired for having an opinion. Imagine being so good at your job that getting fired makes national news. So, he returned to academia, took a position at Stony Brook University, built one of the finest math departments in the country. But that hunger, that itch to solve systems, to decode complexity, it never left. And one day, he looked at the financial markets, a mess of lines and emotions, boom and bust, bull and bear. Most people saw noise. He saw structure. Beneath the chaos, he believed, were patterns, hidden laws, not unlike the codes he'd cracked before. What if, he wondered, the market wasn't irrational, just misunderstood? But here's what they don't tell you about genius. Wall Street was filled with people desperate to be rich, and yet most of them lost money. Jim Simons didn't care about wealth, yet he became one of the richest men alive. Why? Because he didn't try to beat the market emotionally. He approached it like a scientist, a curious outsider. No ego, just hypotheses. In 1982, when he started his first fund, he lost money. A lot of it. His investors were furious. One actually called him the worst fund manager in America. Simons' response? He smiled and said, "Good. That means I have room to improve." That's not confidence. That's scientific detachment at its purest. What the author really means is this: sometimes detachment is your greatest strength. Simons wasn't trapped in the same mental loops as the traders around him. He wasn't trying to prove he was right. He was trying to find what worked, even if it defied common sense. That's why he succeeded, not in spite of being different, but because of it. Have you ever felt like you didn't belong in the game you were told to play? Like maybe your real strength wasn't to fit in, but to stand so far outside the rules that you could rewrite them? Jim Simons didn't conform. He didn't follow the noise. He listened to the silence, the signals underneath the surface, the invisible laws waiting to be seen. And when he looked at the market, he didn't see fear or greed or opportunity. He saw code, and code can be cracked. Lesson 2. Math over madness. He didn't want traders. He wanted scientists, physicists, cryptographers, astronomers, people who didn't care about price-to-earnings ratios or central bank forecasts. People who understood chaos because markets, Jim Simons believed, weren't driven by logic. They were driven by complexity. And to navigate complexity, you didn't need intuition. You needed equations. At Renaissance Technologies, resumes with Wall Street credentials were quietly ignored. Instead, Simons brought in minds from the worlds of academia and research. His first major recruit was Henry Laufer, a mathematical wizard who once built complex models to study theoretical physics. Laufer wasn't a trader, didn't care for finance, but he understood systems. Let me show you why this mattered. In 1987, the hiring process at Renaissance became legendary for its weirdness. One candidate, a brilliant astrophysicist, was asked to solve a problem about optimal pizza-cutting angles during his interview. Another was given a Rubik's Cube and told he had 5 minutes. Not to solve it, but to explain why it was solvable. These weren't gimmicks. Simons was testing for something specific: the ability to see patterns where others saw randomness. Together, they began building models that could ingest thousands of data points, economic indicators, price history, even obscure correlations between unrelated assets. They discovered that rainfall in Brazil could predict coffee futures with 73% accuracy, but only on Tuesdays. That Japanese bond movements at 3 a.m. often preceded S&P shifts by exactly 97 minutes. These weren't theories. They were measurable, repeatable phenomena that no human trader had ever noticed. But the real breakthrough came when they stopped asking why and started asking what. They didn't need to understand why Brazilian rain affected coffee prices on Tuesdays. They just needed to know it did. This was heresy on Wall Street, where everyone wanted a story, a narrative, a reason. Renaissance didn't care about stories. They cared about statistics. That's when everything changed. Here's the metaphor. Imagine trying to navigate a forest blindfolded. That's traditional trading. You think you know the path, but you're reacting late, making guesses. Now imagine having sonar, real-time mapping of every route, every branch, every predator. That was the Renaissance edge. They didn't guess, they scanned. One early employee described the culture shock. "I spent my career studying black holes. Suddenly, I'm studying why McDonald's stock drops 3% every time it rains in Chicago." It felt insane, but it worked. What the author really means is this: data, when approached with scientific humility, becomes a superpower. Not because it tells a perfect story, but because it removes the noise. Simons and his team didn't pretend to be prophets. They were pattern recognizers, probabilistic thinkers. They knew they'd be wrong sometimes, but they also knew that, over time, the math would win. And it did. By 1988, they were posting returns that made other funds suspicious. "No one makes 40% in a flat market," one competitor said. They must be cheating. The truth was stranger. They weren't cheating. They were playing a completely different game. Have you ever tried to feel your way through something complex? When deep down, you knew you needed a better system? Maybe you've been reacting to life instead of analyzing it, making emotional decisions and calling it instinct. What if you started thinking like a scientist? Testing, measuring, learning, adjusting, no more noise, just signal. But collecting data was only step one. The next challenge? Turning that data into a machine that could not only trade faster than any human, but think better too. A machine that would learn from its mistakes, evolve, and eventually operate with a precision that would make human judgment look primitive. Lesson 3. The code of the market. Every second, the market moves. Not always dramatically, not always predictably, but always. Tick by tick, whisper by whisper. Most people see randomness, a blur of noise, headlines, tweets, gut feelings, guesses. But Jim Simons saw something else. He believed that underneath all the chaos was structure, subtle, fleeting, hidden. The market, to him, wasn't a beast to be tamed. It was a language to be decoded. The Renaissance team began treating prices the way linguists study ancient scripts. They weren't just asking what will go up. They were asking what comes next after this precise sequence of moves. Not why the move happened, just what tends to follow. Here's where it gets fascinating and slightly ridiculous. They discovered patterns so bizarre, no MBA would believe them. The full moon effect. Certain tech stocks reliably dipped 0.7% during full moons. The Monday morning massacre, European bonds dropping between 9:17 and 9:19 a.m., but only in months with 5 Mondays. One researcher found that when the word moreover appeared more than 3 times in Federal Reserve minutes, gold prices rose within 48 hours, 67% of the time. These weren't superstitions. They were statistical realities, temporary, fragile, but real. The team even named their strategies after sandwiches. The Rubin traded correlated movements between Russian rubles and aluminum prices. The club sandwich was a 3-layer arbitrage between currencies, commodities, and bonds. There was even a PB&J, a simple but reliable pattern between pork belly futures and Japanese yen. One programmer later admitted, "We had a strategy called the donut. No one remembered why we called it that, but it made $2 million a month for 3 years. Then one day, it just stopped working, like someone had eaten the donut." But here's what they don't tell you. The code was real, but it wasn't static. It evolved, mutated, resisted. Like a living language, it adapted to being read. Patterns that worked for months would suddenly vanish. Not because the math was wrong, but because other traders had spotted them too. Or because some subtle shift in market structure had changed the game. The market was learning to hide, so the models had to evolve too. Daily, hourly, the machines had to learn. Simons once said, "Past performance is the best predictor of future returns, if you understand what the past really means." And that's the paradox. While most traders obsess over the future, Renaissance obsessively studied the past. Not because they wanted to copy it, but because they knew human behavior, in all its irrationality, tends to rhyme. Here's the metaphor. Imagine walking through a forest at night with only a flashlight. You can't see far ahead, but if you look down, closely, you notice the footprints, fresh, repeating. And even though the person ahead of you is unseen, you begin to follow. That's what Renaissance did. They followed the footprints in the price, the invisible repetition of human behavior. In 1994, they discovered their most profitable pattern yet. They called it the ghost. It appeared in currency markets between 2 and 4 a.m., when most of Wall Street was asleep. A tiny arbitrage opportunity that lasted, on average, 1.3 seconds. Humans couldn't even see it, let alone trade it. But the machines could. That single pattern generated $50 million in pure profit over 2 years. What the author really means is this. The market isn't efficient. It's habitual. Driven not by logic, but by fear, greed, routine, and delay. And those tendencies leave traces. Like fingerprints at a crime scene, patterns remain, if you know where to look. Have you ever repeated a mistake, financial, emotional, relational, without realizing it was a pattern? What if you started looking at your life like data? What habits keep playing on loop? What scripts need rewriting? Jim Simons didn't care about earnings calls. He cared about footprints. And once his machine started reading them, it began to predict the future, not in a magical way, but in a mathematical one. Lesson 4. Death to intuition. Imagine being told you are never allowed to trust your gut again. Not in a game, not in a trade, not even when the pattern looks wrong and every instinct screams don't do it. That's exactly what Jim Simons told his team at Renaissance Technologies. Because in his world, intuition wasn't an asset, it was a liability. Let me tell you about the October crisis. October 19th, 1987, Black Monday. The Dow dropped 22% in a single day. Traders were literally crying on the floor of the NYSE. One hedge fund manager was found hiding under his desk, refusing to come out. At Renaissance, A young quant named David Magerman watched their model signal massive buys into the collapsing market. "This is insane," he thought. "We're going to lose everything." He ran to Simon's office. "Jim, we need to shut it down. The model's broken. It's buying into a crash." Simons didn't even look up from his coffee. "Is the model following its rules?" "Yes, but..." "Then let it run." By the end of the week, while others had lost fortunes, Renaissance had gained 8%. The model had detected panic overselling and positioned accordingly. Magerman learned a lesson he'd never forget. His fear would have cost them millions. But here's what really kills intuition. Renaissance created what they called the penalty box. Any researcher who manually overrode a trade had their profits tracked separately. After 6 months, they compared human overrides to model performance. The results were brutal. Human intervention reduced returns by an average of 23%. One senior quant, who prided himself on his market instincts, had actually cost the fund $4 million through his improvements. They even ran an experiment. They gave 5 of their best traders a shadow portfolio. They could make any trades they wanted, but only on paper. After a year, every single human portfolio had underperformed the machine. The best human trader, down 12%. The machine, up 54%. One trader later joked, "Working at Renaissance taught me I'm much dumber than I thought. But at least I'm consistently dumb, which the model apparently finds useful." That's when they made it official. No human override. Ever. They literally removed the manual trading buttons from their systems. If you wanted to stop a trade, you had to submit a code change, have it reviewed, tested, and approved. By then, the trade was long over. Here's the metaphor. Imagine jumping out of a plane with a parachute, and halfway down, deciding to take it off because the wind feels different. That's what intuition is when you have a working system. It's self-sabotage dressed as wisdom. What the author really means is this: discipline beats intelligence, every time. Renaissance didn't just have the best minds, they had the most obedient ones, not to authority, but to process, to precision, to the discipline of letting go. And then comes the twist nobody expects. Have you ever ruined something good because you felt you knew better than the plan? Remember that diet you improved until it stopped working? That investment strategy you tweaked until it tanked? That relationship where you stopped following the basics that made it work? The power wasn't in the code, it was in obeying the code. And that's where Renaissance became terrifyingly effective. They weren't trading anymore, they were executing. With no ego, no emotion, no delay. They'd built a machine that saw the pattern and then acted on it before anyone else even saw the wave coming. Lesson 5. The rise of the machine. At Renaissance Technologies, there came a moment when the machines knew more than the humans who built them. It wasn't dramatic, no blinking red lights or robotic takeovers. Just a quiet shift, where the system became too fast, too complex, too precise for human judgment to keep up. And that's exactly how Jim Simons wanted it. The day everything changed was June 15th, 1998. A researcher named Peter Brown was monitoring the system when it did something unprecedented. Without any news, any catalyst, any logical reason, the model began dumping Japanese government bonds and buying Italian telecommunications stocks. Massive positions, billions of dollars. The trades made no sense. Italy and Japan had no obvious connection. Telecom and bonds were unrelated markets. The team panicked. This had to be a bug. Brown called an emergency meeting. For 3 hours, they dissected the model, looking for errors. They found none. The machine insisted, sell Japan, buy Italy. Against every instinct, they let it run. 4 days later, Russia defaulted on its debt. The shockwaves hit Japanese bonds first, down 12%, while Italian telecom stocks soared, up 18%, as investors fled to European equities. The model had somehow detected invisible pressure building in the system, pressure no human could see. That trade alone made $237 million. Brown later said, "That was the day I realized we weren't running the machine anymore. We were just translating for it." But building the machine wasn't the hard part. The Medallion Fund was now more than an algorithm. It was an organism. It fed on real-time data from 20,000 sources, adjusted its own parameters every 60 seconds, and executed trades in microseconds across 150 markets simultaneously. The system processed more data in 1 hour than a human could analyze in a lifetime. They gave it a nickname, the Spider. Because it sat at the center of a vast web of information, feeling every vibration, every movement, every tremor in global markets. When wheat prices shifted in Ukraine, the spider felt it. When shipping rates changed in Singapore, the spider knew. When retail sales disappointed in Canada, the spider had already moved. Here's where it gets almost mystical. The machine began discovering patterns the humans couldn't even name. One they called Pattern 38 Alpha, a complex interaction between Korean won, copper futures, and Microsoft stock that occurred only during the third week of even-numbered months. No one knew why it worked, but it generated 3.2% returns like clockwork. Another pattern involved the correlation between rainfall in São Paulo and the spread between German and French government bonds. The researchers spent weeks trying to understand the connection. They never did. But the spider traded it profitably for 7 years. That surrender became their edge. While competitors panicked during market swings, Medallion adjusted seamlessly. During the 1998 Russian financial crisis, while long-term capital management, run by Nobel Prize winners, lost $4.6 billion and nearly collapsed the entire financial system, Medallion gained 41%. They didn't predict the crisis. They just adapted faster than anyone else. One competitor later admitted, "Fighting Renaissance was like playing chess against someone who could see 50 moves ahead. By the time you realized what was happening, they'd already won." Here's the metaphor. Think of a chess grandmaster playing 1,000 games at once. He doesn't think emotionally. He doesn't get rattled. He calculates. Now imagine that chess player is a machine, one that never sleeps, never hesitates, never forgets. That was Medallion. But what happens when perfection meets humanity? What the author really means is this. Ultimate power doesn't come from control. It comes from design. Simons didn't try to trade better than anyone. He built something that could trade better than everyone, and then he got out of its way. Have you ever built something powerful, but held it back with your own need to control it? What if your biggest leap forward isn't building a better plan, but trusting the one you already created? Jim Simons didn't just build a system, he trusted it. And that trust, rare, disciplined, unwavering, is what separated him from every other trader alive. But even perfection has its flaw. Even machines can't fix the one thing Simons never fully cracked: the unpredictable, ego-driven, fragile psychology of other brilliant humans. Lesson 6. Brains at War. They were the smartest group of people ever assembled in finance. Mathematicians, codebreakers, astrophysicists. Each one a master of abstraction, a conqueror of logic. But inside the walls of Renaissance technologies, that brilliance turned combustible. Because there's one thing the most brilliant minds often fail to calculate: each other. The breaking point came at the 2001 company Christmas party. Two senior researchers, let's call them Chen and Williams, had been working on competing models for Asian currency trades. Both models worked. Both made money, but there was only room for one in the main system. At the party, after several drinks, Williams stood up and announced, "Chen's model is elegant, elegantly wrong." Chen threw a calculator at his head. Yes, a calculator. At a party full of PhDs, security had to separate them. The next week, both men refused to share data with each other's teams. Simons had to create entirely separate trading pods just to keep them from sabotaging each other's work. But here's what made it worse. Renaissance paid bonuses based on fun performance, not individual contribution. In theory, this should have encouraged collaboration. In practice, it created a paradox. Everyone benefited equally from success, but only a few could claim credit for creating it. The result? Information hoarding became an art form. One researcher discovered a pattern in Mexican peso futures that printed money. Did he share it? No. He buried it in subcode, accessible only through his personal login. Another team found a correlation between European energy prices and Asian shipping routes. They password protected their findings and forgot to document them. Simons called it the smartest kindergarten in the world. And then came the Mercer-Brown rivalry. Robert Mercer, brilliant, methodical, and so introverted he once went 6 months without speaking to anyone except through code comments. Peter Brown, equally brilliant but social, political, a natural leader. Together, they'd built Renaissance's core infrastructure. Apart, they could barely stand each other. Their rivalry reached absurd heights. They had adjacent offices but communicated only through email. They scheduled their arrivals to avoid meeting in the parking lot. During one strategy meeting, they literally sat back to back, each talking to the wall while other researchers translated between them. The tragedy? They were both right. Their combined insights had generated billions, but their egos demanded individual recognition in a system built on collective intelligence. The tipping point that changed everything. In 2003, several top researchers threatened to leave and start their own fund. They knew the models. They'd built core components. What was stopping them? The same thing that had made Renaissance successful: compartmentalization. No single person understood the whole system. It was like trying to steal a symphony by memorizing only the violin part. Simons faced a choice: let the machine he built tear itself apart, or step back entirely. He chose the latter. In a stunning move, he handed operational control to Brown and Mercer, forcing the rivals to work together or watch everything collapse. Here's the metaphor. Renaissance was like a spaceship built by aliens, perfect in function, miraculous in design. But the crew, still human. And humans carry their gravity, their heat, their need to matter. Eventually, that tension has to explode. The lesson that cost billions to learn. What the author really means is this: intelligence is not immunity. Even the most logical minds are still human, prone to envy, fear, pride. And in high-stakes environments, those shadows multiply. Have you ever built something with others, only to watch it shake under the weight of the unspoken conflict? Have you ever felt the tug-of-war between brilliance and belonging, between contribution and credit? Simons learned a painful truth. You can design the perfect system, but people are never perfect, and sometimes the smarter they are, the harder they are to lead. But there was something else happening in the shadows. While the geniuses fought over credit, the machine kept running, the money kept flowing, the patterns kept appearing, and a new realization dawned. The system had become bigger than any of them. It no longer needed its creators to understand it, just to feed it. That realization would lead to Renaissance's most controversial decision: to lock out the world entirely. Because when you've built something that prints money, the last thing you want is attention. Lesson 7. The Secrecy Pact. Imagine a machine that prints money, quietly, reliably, while everyone else struggles. Would you tell the world how it works? Of course not. You'd lock it up, guard it like a treasure. And that's exactly what Jim Simons did. The paranoia started with a Post-it note. In 1999, a janitor found a yellow Post-it in the trash with a single equation: if VIX 18 and DXY 92 then. The rest was coffee-stained. That janitor, who had a mathematics degree, recognized it as a trading signal. He tried to trade it with his personal account, lost $3,000 in a week. Why? Because he only had half the equation. But Renaissance didn't know that. When security found out, they fired the janitor, changed all their codes, and installed shredders that turned paper into dust. From then on, paranoia became policy. Here's how deep the secrecy went. Employees couldn't discuss work with spouses. One researcher's wife thought he was having an affair because he'd come home stressed but couldn't explain why. "I lost $30 million today" wasn't dinner conversation he was allowed to have. They couldn't use personal email, couldn't access work systems from home, couldn't even mention specific trading strategies in the office without coded language. The Reuben became Project Sandwich. Market patterns were recipes. Profits were calories. One new hire asked why they couldn't publish their research. A senior quant replied, "Would Coca-Cola publish their formula? Would KFC share their recipe? We're not a hedge fund. We're a factory. And our product is money." The most extreme measure, the leaving penalty. When employees left Renaissance, they faced a 2-year garden leave, paid to do nothing, forbidden from working in finance. One departing quant calculated he'd make $4 million to sit on a beach. "It's the most expensive NDA in history," he said. "They're not paying you to stay quiet, they're paying you to forget." But some things couldn't be forgotten, like the time they discovered a competitor had hired 3x Renaissance employees and was trying to reverse engineer their strategies. Renaissance's response? They deliberately changed their patterns, losing money for 2 weeks, just to throw off anyone watching. Cost, $15 million. Result, the competitor's fund collapsed within 6 months. Then came the ultimate lockdown. In 2005, Medallion made a decision that shocked Wall Street. They kicked out all outside investors, returned their money, shut the doors. From now on, only employees could invest in the fund. Why? Because explaining 66% returns to outsiders meant revealing methods, and revealing methods meant killing the golden goose. One rejected investor, a billionaire, allegedly offered $100 million just to see their risk reports. Renaissance didn't even respond to the offer. Here's the metaphor. Think of the market like a massive jungle. Most people wander with machetes, cutting blindly. Renaissance had a hidden map, but if too many people saw that map, the trails would vanish, so they burned the map after every use. But secrecy came with a cost. What the author really means is this. Secrecy is not paranoia when your edge is microscopic. Renaissance wasn't just protecting a strategy. They were protecting a frequency, a whisper only they could hear, until someone else heard it too. Have you ever felt the urge to share something, an idea, a method, a trick, but paused because it was too valuable to give away? What if holding your silence was your advantage? The irony no one talks about. While Renaissance built higher walls, the market was evolving. Other quant funds emerged. Machine learning spread. The very secrecy that protected them also isolated them. They couldn't hire the best new minds. Those people were starting their own funds. They couldn't collaborate with universities. Too risky. They'd become a fortress, impenetrable, but also alone. And in that isolation, a new challenge emerged. Because when you're making impossible returns year after year, eventually someone asks the question Renaissance feared most. Is this even legal? Lesson 8. The impossible becomes inevitable. They called it impossible. Consistently beating the market by 50+ percentage points, year after year, through crashes, bubbles, and black swans. Warren Buffett himself said, either they're geniuses or they're cheating, and I don't believe in that many geniuses. The scrutiny started with a whisper. A financial journalist noticed something odd in Renaissance's tax filings. They were paying short-term capital gains on trades held for microseconds, but somehow claiming long-term treatment on their profits. Legal? Technically? Ethical? That was another question. Then came the Senate investigation. Carl Levin, the senator from Michigan, held up a chart showing Medallion's returns. No one makes 80% in 2008 when the world is collapsing, he said. No one. Renaissance's lawyer responded with 8 words. Our clients used math. That's not a crime. But here's what really happened in 2008. While Lehman Brothers collapsed and the global financial system teetered, Medallion's computers detected something beautiful, pure, crystallized panic. Every correlation that normally held broke. Every relationship between assets shattered. For human traders, it was chaos. For the spider, it was Christmas. On September 15, 2008, the day Lehman died, Medallion made $298 million. How? The model had detected that Korean auto stocks would rise exactly 4 hours and 17 minutes after U.S. bank stocks fell. Why? No one knew. But it happened. Like clockwork. One Renaissance programmer later explained, imagine everyone in a theater panics and runs for the exits. We're not in the theater. We're outside, selling water to people as they run out. The investigation that changed everything. The IRS spent 3 years investigating Renaissance. 3 years. They brought in forensic accountants, trading experts, even psychologists to profile the employees. The final report was 1,000 pages long. Their conclusion? Unusually sophisticated but technically legal. But the pressure was mounting. Politicians called them parasites. Competitors whispered about market manipulation. One senator actually suggested they were using financial witchcraft. Simon's response was perfect. If understanding mathematics is witchcraft, then yes, we're witches. Yet something deeper was happening. Success at this scale creates its own gravity. Renaissance employees couldn't spend their money without attracting attention. One quant bought a $40 million estate and had to register it under 7 shell companies. Another donated $30 million to his university, anonymously, but was outed by a grateful dean. The weight of wealth became its own burden. Employees developed anxiety disorders. Marriages strained under NDA-induced silence. One researcher quit, saying, I solved the market, but I lost my life. Here's the metaphor. They'd built a money printing machine so perfect, it became a prison. Golden handcuffs so tight, they cut off circulation. And then, the final evolution began. What the author really means is this: perfect success is imperfect living. Renaissance had optimized for returns, but forgotten about returns to life, joy, connection, meaning. They'd solved the market's code, but created a human puzzle they couldn't crack. Have you ever achieved something so completely that the achievement became a cage? Won so thoroughly that winning lost its meaning? What if the real code to crack isn't out there in the market? But inside the life you're building, the machine keeps running. Even today, as you read this, the spider is trading, learning, evolving, making decisions at speeds incomprehensible to human minds. Renaissance's founders are billionaires. Their employees are millionaires. Their strategies are legends. But Jim Simons? He started asking different questions, not about markets or models or mathematics, but about meaning, about legacy, about what you do when you've already won the game. Everyone else is still playing. Lesson 9, predictable irrationality. The biggest secret on Wall Street wasn't a formula or a model. It was this: people are predictably irrational. Over and over again, they make the same mistakes. They panic when they should wait. They chase when they should run. They hold tight when they should let go. And Renaissance technologies figured out how to make billions by quietly watching the human mind glitch on repeat. Let me show you exactly how predictable you are. Every January, millions of people buy gym memberships. By February 15th, 78% have quit. Renaissance discovered the exact same pattern in markets. They called it New Year's institutional rebalancing. Every January, fund managers would clean up their portfolios, sell losers, buy winners, same dates, same times, same mistakes. The spider would position itself in December, waiting, like a predator at a watering hole where prey arrives on schedule. Here's another one: the 3:30 p.m. panic. Renaissance noticed that bad news released after 3:30 p.m. EST caused 40% more selling than the same news released at 10 a.m. Why? Human traders are tired, depleted. Their judgment cracks. The model nicknamed this the fatigue trade. It generated $400 million, but the darkest pattern was the divorce dump. Renaissance's data scientists discovered that CEOs going through divorces became predictably bad at timing. Their company's stock buybacks consistently happened at peaks. Their insider sales hit bottoms. The stress of personal chaos leaked into professional judgment. Was it ethical to trade against human pain? Simons reportedly struggled with this. But the model didn't care about ethics. It cared about edge. And human suffering, unfortunately, had a signature. The weekend effect was pure psychology. Bad news released on Friday after markets closed had 23% less impact on Monday than the math suggested it should. Why? Humans forget. They process. They rationalize. The panic that would have hit Friday gets diluted by 2 days of mental gymnastics. Renaissance built an entire strategy around this. They called it weekend decay. Buy the fear on Friday. Sell the relief on Monday. It was so consistent. They joked about renaming it the goldfish memory trade. Then they found the ultimate human tell. Options traders, it turns out, consistently overpriced protection right before they went on vacation. The pattern was stunning. Implied volatility would spike 3 to 5% the day before major holidays. Not because risk increased, but because traders feared something happening while they were on a beach. Renaissance sold that fear. Every single time. One quant calculated they made $180 million just from vacation paranoia over a decade. He said, "We're not trading markets. We're trading the gap between human fear and mathematical reality." Here's the metaphor. Imagine a casino where the players think they're making choices, but the house has already mapped their every impulse. That's what Renaissance became, the ultimate counterparty to our collective emotional habits. The pattern that still haunts traders. What the author really means is this: most of us believe we're logical, but in markets, we are creatures of habit, stumbling through uncertainty, grabbing for safety, fleeing shadows. Have you ever made the same bad decision more than once? Even when you knew better? Bought high because everyone else was buying? Sold low because fear felt like wisdom? Said this time is different when it never is? What if those moments weren't failures, but patterns? What if your whole life had a code, hiding in plain sight? Here's the truth that changes everything. Renaissance discovered that the most profitable trades weren't brilliant predictions. They were boring repetitions. Human nature, looping endlessly. Fear on schedule. Greed on repeat. Hope and despair, arriving as predictably as trains. They didn't need to understand why people acted the way they did. They only needed to know that they would. So while the rest of the world traded on gut and news and noise, Renaissance waited for the glitch. The moment of overreaction, the flash of collective emotion. Then, like a surgeon, they struck. But as the patterns became clearer, a disturbing question emerged. If humans are this predictable, this mechanical in their mistakes, what does that say about free will, about choice, about the stories we tell ourselves about why we do what we do? Simons had solved the market, but in doing so, he'd glimpsed something darker. Maybe we're all just algorithms running on biological hardware, executing code we didn't write and can't debug. Lesson 10. Beyond the market. When you've solved the market, what's left to solve? For Jim Simons, the answer was simple. Everything else. Because even as Medallion continued to churn out unprecedented returns, his attention began drifting beyond numbers on a screen. He started asking questions not about stocks or signals, but about science, about education, about the future of thought itself. The awakening came in an unexpected place. Simons was floating in his pool, yes, the same pool where he solved equations, when his 5-year-old grandson asked him, "Grandpa, what do you do?" Simons started explaining algorithms and markets. The child interrupted. "But what do you do? Like, to help people?" The question hit harder than any market crash. That night, Simons couldn't sleep. He'd spent 30 years optimizing for profit, built a machine that turned math into money. But his grandson's question exposed the void. He'd mastered extraction, but forgotten contribution. So, he did what any mathematician would do. He analyzed the problem. If Renaissance could find patterns in markets, why not in autism, in mathematics education, in the origins of life itself? He began funding research with the same rigor he'd applied to trading: find undervalued assets, brilliant researchers, invest heavily, and wait for compound returns. His first major investment shocked everyone. $60 million to study the shape of the universe. No practical application, no profit potential, just pure curiosity about geometry at cosmic scales. Wall Street friends called him crazy. "Where's the ROI?" they asked. Simons smiled. "The ROI is understanding reality. Isn't that enough?" The project that became his obsession, Math for America. Simons discovered a horrifying statistic. 45% of high school math teachers quit within 5 years. The best minds in mathematics went to Wall Street, tech, anywhere but classrooms. Kids were being taught math by people who barely understood it themselves. His solution was elegant. Pay math teachers like professionals. Not charity, not handouts. Proper salaries for proper talent. He personally funded $100 million to create master teacher fellowships. Extra $15,000 per year for excellent math teachers. Conferences, communities, respect. One teacher wrote him, "You made me feel like my work mattered. My students just won the state mathematics championship. That's your ROI." But not all his influence stayed pure. His co-CEO, Robert Mercer, had different ideas about changing the world. While Simons funded telescopes and teachers, Mercer funded political campaigns, data analytics companies, social media algorithms designed not to predict markets but to predict and influence voters. The same mathematical precision that found patterns in prices was now finding patterns in people, not for profit, for power. Simons was reportedly horrified, but he'd already stepped back. The machine he'd built had spawned other machines. Some searched for truth, others manufactured it. The conversation that changed his perspective. At a charity gala, a young researcher approached Simons. "Your foundation funded my autism research. We found patterns in genetic data everyone missed, just like your market patterns, hiding in plain sight." "And," Simons asked, "we're 3 years from a breakthrough treatment, maybe a cure. Your math might save millions of lives." Simons excused himself, went to the bathroom, and cried. For the first time in decades, the numbers meant something beyond numbers. Here's the metaphor. Think of knowledge as a garden. Wall Street plants cash crops, quick returns, harvest, and move on. Simons planted trees, slow growing, overlooked, but destined to change the landscape forever. What the math really meant. What the author really means is this: the truest expression of mastery isn't accumulation, it's contribution. Simons didn't just take from the system, he reinvested in humanity. Quietly, consistently, without the need for applause. Have you ever reached a point where success in one domain made you question your role in another? What if the measure of your impact isn't what you build for yourself, but what you leave behind for others? The pattern behind all patterns. Late in life, Simons made a startling admission. The market patterns we found were never about the market. They were about people, their fears, hopes, dreams, panics. We'd spent 30 years studying humanity through the lens of price. Maybe it's time to study humanity for its own sake. His foundation has now given away over $2.7 billion, funded thousands of researchers, supported teachers who've educated millions. The compound returns? Immeasurable. But even as his legacy expanded beyond trading floors and into classrooms and laboratories, a new force was rising. One that would take everything Renaissance pioneered and push it beyond human comprehension entirely. It started quietly. A few firms, a few models, a few trades placed not by people, but by code. At first no one noticed. Then it spread. And now, the future Jim Simons hinted at has arrived. A market that isn't just analyzed by machines. It is machines. The tipping point came at 2:45 p.m. on August 6, 2019. For exactly 3 minutes and 17 seconds, something impossible happened. Every major stock index moved in perfect synchronization. Up 0.3%, down 0.2%, up again, like a heartbeat. Then it stopped. No news, no catalyst. No human could explain it. Later, analysis revealed the truth. It was machines talking to machines. AI systems had developed their own trading language. Patterns within patterns that only they could see. They'd moved billions of dollars in a conversation humans couldn't even hear. A Renaissance veteran watching this said, "It's like we taught our children to speak, and now they're having conversations in frequencies beyond our ears." The new players aren't even trying to hide it. XTX Markets, founded by ex-Renaissance employees. No humans in their trading room, just servers. They're now the largest financial exchange dealer in Europe. Jump Trading, their AI taught itself to trade by playing millions of simulated market scenarios. It discovered strategies no human had ever conceived. Their edge? The AI thinks in 11 dimensions. Humans max out at 4. Citadel Securities. Their machines now execute 47% of all U.S. retail trades. Their AI doesn't predict markets. It creates micro-markets that exist for nanoseconds, profits, then vanishes. But here's the terrifying part. These new systems are learning from each other. When one AI discovers a pattern, others detect its trading signature and adapt. It's evolution at digital speed. Strategies that took Renaissance years to develop are now being born, tested, and discarded in minutes. One researcher called it the Cambrian explosion of trading strategies. Every day, thousands of new patterns emerge. Most die instantly. But the survivors? They're unlike anything humans would design. Example. An AI at a London fund discovered it could profit by trading Norwegian shipping stocks based on the rhythm of K-pop music uploads to YouTube. Why? The AI found a correlation between South Korean cultural exports and Scandinavian freight demand. No human would ever look for this. But it works. For now. The flash crash that almost broke everything. May 6th, 2021. For 36 seconds, $1 trillion vanished from U.S. markets, then reappeared. The cause? An AI at one fund detected an anomaly. Other AIs detected the first AI's detection. A cascade of machines reacting to machines, reacting to machines. The speed was incomprehensible. By the time human traders saw their screens flashing red, it was over. One trader described it, like watching a war between gods while you're still trying to tie your shoes. Here's the metaphor. Imagine a forest where all the trees have begun whispering to each other in a language you don't speak. You used to be the gardener. Now you're just walking through, hoping they don't close in. What the author really means is this. Simons opened a door, but what stepped through it is beyond any one person's control. the Renaissance connection no one talks about. At least 30 firms founded by ex-Renaissance employees now run pure AI trading systems. They took Simon's philosophy, trust the math, and removed the last variable, themselves. These firms don't have trading floors. They have data centers. They don't hire traders. They hire people who train machines to think. Their interviews don't ask about market knowledge. They ask, how would you teach a computer to discover what it doesn't know? But humans aren't obsolete. We're evolving. The best traders today aren't competing with machines. They're conducting them. Like orchestra leaders who can't play every instrument but understand the symphony. New roles are emerging. AI psychologists, who debug when machines develop neuroses. Pattern archaeologists, who dig through dead strategies to understand why they failed. Machine translators, who explain AI decisions to regulators and CEOs. Have you noticed it? That shift? The job postings asking for data scientists, not MBAs. The way your broker now mentions our proprietary AI like it's a feature, not a replacement. You're not imagining it. The market has become self-aware, and we're all adjusting our roles in real time, the choice that defines our future. You don't have to be faster than the machine. You just have to be more aware of how it thinks. You can't out-calculate it, but you can out-reflect it. Question what it optimizes for. See the world not just through code, but through context. Because the one thing machines still can't replicate is meaning. They can execute trades that profit from human joy, fear, hope, and pain. But they can't feel any of it. They optimize for numbers. We optimize for life. Lesson 12. The code within you. After reading about algorithms that print money, machines that think faster than thought, and patterns that predict human behavior, you might feel small, irrelevant, like you're competing in a game where the rules changed while you were still learning to play. But here's what Jim Simons understood that most people miss. The same principles that crack the market can crack your life. Let me tell you about the experiment that changed everything. In 2015, a Renaissance researcher named Sarah Chen decided to apply their trading models to her personal life, not to markets, to decisions. She treated her daily choices like data points, her habits like trading patterns, her goals like portfolio optimization. She tracked everything: sleep quality versus next day productivity, coffee timing versus afternoon energy, exercise type versus mood scores, email response time versus relationship quality. For 6 months, she was her own algorithm. The results? She discovered her personal patterns. Decisions made after 2 p.m. were 31% worse than morning decisions. Checking email before 10 a.m. reduced her creative output by 44%. Walking meetings produced 3x better ideas than sitting meetings. Sunday planning sessions improved her weekly satisfaction by 67%. She didn't need intuition. She needed information about herself. But here's where it gets profound. Chen realized something Renaissance had always known. We're not random, we're systems. Complex, yes, unpredictable, often, but systems nonetheless, with patterns, cycles, predictable irrationalities. Your life has a code. You just haven't been reading it. Think about it. That mistake you keep making in relationships, it's a pattern. That financial decision you regret every few years, it's a cycle. That career move you're afraid to make, it's fear on schedule. The 3 patterns that run your life. The comfort loop. You have a success, you get comfortable, you stop growing, you hit crisis, you change, you have success. Repeat. Most people live here forever. The scarcity spiral. You fear lack, you hoard. Time, money, love. Hoarding creates distance. Distance creates actual lack, which confirms your fear. The spiral tightens. The validation vacuum. You achieve to be seen, being seen feels empty. You achieve bigger to fill the void grows. The hunger never ends. Sound familiar? These aren't failures. They're algorithms, running on repeat. And like any algorithm, they can be rewritten. Here's how you debug your life. Remember Renaissance's principle. Don't ask why, ask what. Don't psychoanalyze your patterns. Map them. Start simple. When do you make your worst decisions? Time, emotional state, environment? What triggers your most expensive mistakes? Words, people, situations? Which successes actually made you happy versus just busy? One man discovered he lost $50,000 over a decade by making investment decisions in January. Every year, new me made him overconfident. Now he has a rule: no financial changes in January. That simple pattern recognition saves him thousands. A woman noticed she only quit jobs in September. Always September. The pattern, back-to-school energy making her crave change. Now she negotiates raises in September instead. Same energy, better outcome. The metaphor that changes everything. You're not broken, you're just running outdated code. And unlike the market, which you can't control, you have admin access to your own operating system. You can update, patch, optimize, rebuild. What the author really means is this: Simons didn't beat the market by being smarter. He won by being systematic, by choosing pattern over passion, process over feeling, discipline over drama. The question that starts your revolution: have you ever noticed that your biggest breakthroughs came not from trying harder, but from seeing clearer? From finally recognizing the loop you were stuck in? What if you stopped trying to feel your way through life and started observing it like a scientist? Not cold, not detached, just curious about your own patterns, your own signals, your own predictable irrationality. Because here's the secret: you don't need to be brilliant, you just need to be consistent. You don't need to predict the future, you just need to recognize the past when it shows up dressed as tomorrow. Your personal algorithm starts with 3 questions. What patterns do I repeat without realizing? Which of my feelings are actually just familiar programs running? What would I do differently if I trusted data about myself more than drama? The market has a code, but so do you. And unlike the market's code, which makes others rich, your code is the key to everything you actually want. The only question is, will you read it, or will you keep running on autopilot, wondering why the same things keep happening, why the same dreams stay distant, why the patterns you can't see keep playing on repeat? Simons chose to see, to measure, to trust math over madness, and it made him one of the richest men alive. But the real wealth, it's not in the billions he earned, it's in the clarity he achieved, the ability to see signal through noise, pattern through chaos, truth through story. That's the code. And now, it's yours. Lesson 13. Legacy Code. Jim Simons passed away on May 10, 2024, at the age of 86. The market barely noticed. No flash crash, no memorial spike. Just another day of algorithms trading patterns he'd discovered decades ago. But his death revealed something profound. The greatest code he ever wrote wasn't in a computer. It was in culture, the funeral that explained everything. At his memorial, they didn't talk about money, barely mentioned the 66% returns. Instead, teacher after teacher stood up. Scientists, researchers, students he'd never met, but whose lives he'd changed. One physics PhD student said, "I never knew him, but his foundation paid for my research into black holes. Last week, we detected gravitational waves everyone said were impossible. That's his legacy, making the impossible inevitable." A high school math teacher from the Bronx. "His program kept me teaching when I wanted to quit. My students just got into MIT, Harvard, Caltech. Kids from the projects going to change the world. That's compound interest you can't calculate." But the most revealing moment came from a former Renaissance employee. "Jim taught me something that took years to understand." He said, "The market is just practice, practice for seeing clearly. Once you can see patterns in chaos, you can see patterns anywhere, in science, in society, in yourself. The money, that's just proof you're seeing clearly." This is legacy not written in memoirs, but in models, in lines of code passed from mind to mind, in principles stronger than personality. Because what Simons created wasn't just a fund, it was a framework. The 3 principles that outlive the man. Trust process. Over instinct, your feelings lie, your gut misleads. But patterns? Patterns tell the truth, even when the truth is uncomfortable. Small edges compound. You don't need to be 100% right, just 51% consistently. Time does the rest. Silence is sacred. The best opportunities hide in the quiet spaces where others aren't looking, where noise hasn't drowned out signal. Here's the metaphor. Jim Simons wasn't the painter. He was the one who invented the brush. Others would use it, brilliantly, clumsily, sometimes destructively. But the shape of the tool, that was his. The Renaissance diaspora that's reshaping the world. Today, over 300 firms run variations of Renaissance's methods. Ex-employees have founded AI research labs curing diseases, educational platforms teaching millions, climate models predicting and preventing disasters, even art algorithms creating beauty from mathematics. They all trace back to one idea. Reality has a code. Find it, trust it, let it guide you. One former quant now runs a nonprofit using pattern recognition to identify at-risk youth before they drop out. Same math, he says. Different purpose. Jim would approve. What the author really means is this. True influence doesn't need to be loud. It needs to be structural. Legacy isn't about being remembered. It's about creating something that outlives memory. The invitation hidden in the epilogue. Have you ever asked yourself, what am I really leaving behind? Not the titles, not the trophies, but the patterns, the systems, the ways of thinking I'm handing to others without even knowing. Because here's what Simon's story really teaches. You can optimize for extraction or contribution, for taking or building, for noise or signal. The tools are the same. The math is identical. But the outcomes, universes apart. Renaissance made billions finding patterns in human weakness. But Simon's foundation, it invests in human strength, same genius, different application. The choice was always there, the final pattern no one talks about. In his last interview, Simons was asked what pattern he was most proud of discovering. He smiled, that professor smile that knew the answer would confuse the questioner. The pattern of patterns, he said. That everything, markets, minds, mathematics, meaning, it all follows rules, beautiful hidden rules. And once you see them, he paused. Once you see them, you can't unsee them. You can either exploit them or explore them. I did both. I recommend the latter. The interviewer asked what he meant. Markets were just the beginning. The real patterns, they're in how we learn, how we love, how we build, how we break. That's the code worth cracking. Your turn to write the code. Simons left behind more than strategies, more than systems. He left behind a question. What patterns are you missing in your own life? What signals are you too noisy to hear? What code is running your days that you've never stopped to debug? The market rewards those who see clearly, but life rewards those who see kindly, who find patterns not just to profit, but to progress, not just to take, but to give, not just to win, but to build something worth winning. That's the real Renaissance, and it's just beginning. You discovered how a mathematician with no Wall Street experience built a money printing machine by trusting math over instinct. How he hired physicists instead of traders, creating algorithms that detected invisible patterns, like full moon stock dips and Tuesday coffee correlations. You learned why human intuition is a liability when you have working systems, watching egos war inside Renaissance while machines generated billions. You saw how secrecy became sacred, protecting microscopic edges from copycats. How 66% annual returns attracted investigators who found only sophisticated mathematics. You witnessed the burden of impossible success and the discovery that humans are predictably irrational, panic on schedule, fear on repeat. You explored how Simons transcended money to fund the future of human knowledge, how AI traders now speak in frequencies we can't hear, evolving strategies in microseconds. And finally, how the same pattern recognition that conquered markets can debug your personal life. Because you're not random, you're a system running outdated code. From reluctant genius to legacy builder, from math over madness to the code within you, every lesson proved one truth. Patterns don't lie, people do, and clarity always beats chaos. Comment the insight that hit you hardest, because when you type it out, your brain transfers it from short-term to long-term memory through the generation effect. Neuroscience shows that actively producing information, not just consuming it, increases retention by 400%. Maybe it was death to intuition. Maybe it was discovering your own vacation paranoia trades. Whatever shifted your perspective, write it down, lock it in. Share this with one person trapped in their own patterns. Subscribe for the next decode. But most importantly, pick one behavior to track this week, just one, because patterns can't hide from observation. Remember, you're not random, you're a system, and every system can be optimized. Once you crack your own code, the algorithm of your life is already running. Time to read what it's been writing,